Welcome to Fear and Greed Summer Investing Series, brought to you by Vanta, specialists in compliance-led growth. I'm Sean Aylmer. Some of the most interesting companies on the ASX are found among the small caps. So today we're looking at the opportunities for investors in smaller companies across the next 12 months. As always, this is general information only, and you should seek independent advice before making investment decisions. Matthew Kidman, principal at Centennial Asset Management, has been looking at small caps for many, many years. Welcome back to Fear and Greed.
Hi, Sean. Thanks for having me.
So, small caps, been a rough few years for them. We're heading into a new year. What do you reckon?
Well, last year I said the small cap index could be up 25%. I had to look at it just today, and it's up between 8 and 9, about 8%. So a bit disappointing again. Not a disaster like a couple of years ago it was down, but I think it can go higher. I would have hoped by now that we would have an interest rate cut in the bag and talking about another one. But as you know, that's been stalled and we're not quite sure when it is, whether it is in February or is it later in the year. It all depends on the economic data. That would kick along small caps. The US small caps have started to run the Russell 2000. It's up 17%. So, there's good signs ahead, but it's just a bit slow out of the blocks, unfortunately.
What is it about small caps? As an investor, if I want to look at small caps, what are the parameters I should put around small caps versus mid caps or versus large caps?
Yep. So small caps are less liquid. They will move around more. So the individual stock volatility is high. No small cap is too big to fail. You're not going to get bailed out. You're at risk. So it's a risky end of the market. What do you got to look out for? You've got to look out for balance sheets in particular, because banks and lenders can turn on small caps very quickly if something goes wrong. And at that end of the market, most of the time through a cycle, you want higher growth than normal. Otherwise, you can go up to the big cap end, be secure in a bank, high liquidity. You know the bank's not going to go broke, or if it does, we're in trouble, but it probably won't. And it's got a great franchise that chugs along. Small caps are the polar opposite to that.
Okay, so sector-wise, what areas do you like over the next 12 months and which ones do you think you might just be a bit cautious on?
Yeah, so what's worked in Australia and elsewhere, as we know, has been structural growth. So, okay, I mentioned before interest rates, we would have liked them to come down, but they actually have steadied primarily, and inflation has been coming down. So that has allowed the structural growth stories to run. That is primarily technology, but it's not exclusively technology. There's some financial stocks that are growing regardless of the economy, and that's what I mean by structural. Once we get an interest rate cut or two, assuming we go down that path, I think then we can move into cyclical growth, stocks that benefit from the economy actually starting to tick up. And if the cycle plays out normally down the track, you could probably get into commodities. We're definitely not at that stage. I still think we're in structural growth, but I think cyclical growth will appear during the course of the next 12 months.
So if we get into cyclical growth in the next 12 months, what are the sorts of sectors you're looking at?
You want to be exposed to anything that can grow. You want to be exposed to housing sector, whether in the financials, whether in building materials. You want to be exposed to the consumer in general, because the consumer probably has a bit more money to spend, get a couple of interest rate cuts, consumer on the front foot rather than playing defence and saving their money, using the purse strings, a bit more confident. So anything that goes around, and the structural growth stories can probably still go okay, but they won't give you the bang for the buck that those companies that say, okay, Sean's got more money to spend, he's a little bit more confident, he's going to go out and buy a new shirt, he's going to go and buy a set of golf clubs, anything that latches into that, and then you'll get companies where it really flows on. If companies, and we've heard this from Treasurer Chalmers saying, well, where's the spend from the Australian companies? Once they see a bit of demand for their products, they will then go and spend on CapEx, and that feeds into that cyclical growth story.
Matthew, I can't have you on without asking just for one stock tip.
Oh, I thought you were going to ask me about the banks, which I always get wrong. But one name at the small end that we do like, which is highly risky, is a little company called QuickFee. Its primary business is established in Australia, but it's gone to the US. And what it does, it allows mainly accounting firms and some legal firms to actually allow their clients to pay, and it funds that component because as we know, people don't pay their accountants and lawyers too quickly. It's basically operating in working capital. There's not many businesses like that in the US, and it's starting to get profitable, and it's very cheap.
We'll keep an eye on that one. Matthew, thanks for your time.
Thanks, Sean.
That was Matthew Kidman from Centennial Asset Management. Remember to get your own independent advice before making decisions. This is Fear and Greed Summer Investing Series brought to you by Vanta. Vanta automates compliance for frameworks like ISO 27001, SOC 2, CPS 234 and Essential 8, saving time and money while building trust. Join over 8,000 companies like Atlassian, Dovetail and FireAnt, managing real-time risk. Get $1,000 off at vanta.com/fearandgreed. I'm Sean Aylmer. Enjoy your day.